Hello, everyone. Welcome to the Magenta Edge Digital Workshop series. I am SHENEYA Wilson, CPA and founder of Full Life Financial, and your host of Workshop 4 of 8. Just know that each and every Thursday until April 1st, we will have a different workshop all about the small business experience. We are so happy to be here today with you and be talking about how to make business taxes work for you. To see all the articles and story on Magenta Edge or to register for other upcoming workshops in this series, go ahead and visit tmobile.com/Magenta Edge. T-Mobile for Business will be live tweeting throughout today's workshop, so feel free to go in Twitter and add to the conversation by clicking the Twitter icon on the dashboard on your screen and using hashtag Magenta Edge. Finally, at the end of our conversation, there will be a live Q&A, so feel free to gather your questions as we're going through this presentation, and feel free to ask those questions when we get to that portion. I am super excited, so let's get started with talking about making business taxes work for you. So just to reintroduce myself again, I am SHENEYA Wilson, aka the People CPA, which is a self-proclaimed name because I do pride myself in providing financial services to everyone, when that's where the name kind of came from. So I'm a serial entrepreneur, business, finance, and tax expert. I have been featured in Business Insider, Forbes, New York Times as a featured tax expert. I am also a real estate investor, financial educator, and founded my company, Full Life Financial, in 2017 to provide bookkeeping, tax preparation, tax planning, and financial consulting services to small businesses like you. So I'm super excited to be here with you all talking about how to make business taxes work for you, but then also understanding the basics of business taxes and why the tax code is beneficial to those of us who own businesses. So let's get into the agenda, right? Everyone knows, they want to know, well, what are we going to be discussing today? So number one, we are going to discuss business income taxation. And this is going to be specifically focused on understanding how the structure of your business influences how you file taxes. We'll talk about the business types and understanding what you should be aware of for this tax season since we are in it now. Secondly, we're going to talk about tax types. As we know, we pay taxes almost everywhere, right? Whether it's income taxes or sales tax or tax on, another purchase. We're paying so many types of tax. So we are going to hone into the taxes that are paid specifically by small business owners. And this is going to allow you to just understand what type of things are required for you to stay in compliance as you are operating your small business. Lastly, we'll discuss everyone's favorite tax incentives, right? Let's talk about the tax breaks, the deductions, the credits that are all available for small business owners. Because again, the tax code was created for those of us who own businesses and those who own real estate, but today we're specifically talking about business taxation. Before we get started, just want you all to know that tax laws and deductions are subject to change. So even though we'll have this conversation today, does not mean the same information is going to apply in 5 or 10 years from now, maybe not even next month. But to keep up with the latest in tax deductions, tax incentives, you want to go ahead and verify the tax laws by visiting the irs.gov website. There you have resources and not only about the tax code, but the instructions on how to implement them and to make the tax code work better for you. So let's get into lesson 1. Again, understanding the basics of business income taxation. So let's understand how taxes are related to the business entity. And again, know that the structure of your entity does influence how your business is going to file its taxes. Before we get into that part, let's talk about the different types of business types. Most of us are more common with the first two, which is going to be sole proprietorships and limited liability companies. Those are the most two common entity types. However, other entity types are going to be partnerships, C corporations, and not-for-profit entities. Each of these entities are going to have a different tax implication, and thus you should be aware of how that choice of structure is going to influence how you file your taxes for this tax season. So let's dive into the details of what these things are, right? So again, the most common we hear is LLC. Everyone hears LLC and just assumes that that is, the business entity to go by. However, there is a lot of flexibility to having an LLC, which makes it pretty special. First off, note that LLCs can essentially be taxed 4 different ways. And this depends upon the amount of members that that entity has and their chosen tax election. So for example, if I am an individual and I am the sole proprietor and operator of my business and I file for an LLC, for tax purposes, I am going to be considered as a disregarded entity or sole proprietorship. This means that when I'm filing my taxes, I am filing my business and personal taxes together because, again, under the IRS's eyes, my single member LLC is a disregarded entity. So yes, we have that legal protection, but in regards to how you're filing your taxes, that's going to be done on your personal 1040 tax return on a Schedule C specifically. Now, say for example, I have an LLC and I actually have more than one member. It's me, it's my best friend, maybe it's my mom, and now it's 3 of us. Well, a multi-member LLC is going to default as being taxed as a partnership. Very important to note, and we'll talk about that on one of our later slides. Additionally, with the exception of being a single member LLC or multi-member LLC, which is changes due to the amount of members for the entity, what an LLC can also do is change their tax election. So LLCs can actually elect to be taxed as a C corporation, or it can elect to be taxed as an S corporation. Depending upon your business, what you're grossing, your operations, either of these may be the best case scenario for you. But of course, we always refer people to speak with a professional tax accountant so that you know which entity type and taxation type is going to be correct for your specific business. And now we'll get into C Corps. One of the least common, I would say, because of the whole idea of double taxation. So if you hear C Corp, most people think double taxation. So what double taxation is a tax created when not only are your business taxes, your business income tax at the corporate level, if you take a withdrawal from your corporation and it's not through payroll, it's typically counted as dividends received, meaning that you're going to pay tax on that again at your personal income tax level. So the C Corp is going to file a Form 1120. You, for your personal, will file for the dividends received on your 1040. That tax is going to be paid at the corporate level for your 1120 tax form, but then also for dividend received, that'll be paid for on your personal 1040 tax return. A way to avoid double taxation is going to be to not take out any dividends. So for some individuals that may have a C corporation, it may be beneficial to them because the C corporation tax rate is currently just 21%, right? Just to give some context, the individual tax bracket can range between either a low of 10% and a high of 37%. So when you have a C Corp, you can guarantee a 21% effective tax rate for the corporation. And if you don't take on any dividends, that will be your fixed tax rate. So one way to, again, avoid that double taxation is to have your C Corp pay taxes at the corporate level for that 21% rate. And then to distribute earnings to yourself, you want to go ahead and set up payroll so that you can pay yourself a salary, and that will only be subject to payroll taxes and not taxes upon dividends as well. Now let's talk about pass-through entities. So again, we talked about LLCs, talked about C corporations, how they're taxed differently. What makes an LLC, a partnership, S corporation different from a standard corporation is the fact that these are pass-through entities. And a pass-through business entity is one in which income is passed through to their owners, and it's taxed at that personal income tax rate. So again, think that 10 to 37% scale. So essentially, sole proprietorships, as you earn income, whether you're a single member LLC or you are a sole proprietor without an LLC, your income and expenses are going to be filed on a form Schedule C of your personal 1040 tax return. So yes, again, when you have a business and you are the sole owner, you are, especially if it's an LLC, you are not filing two separate tax returns for your business, which I do believe is a common myth that I see entrepreneurs struggle with, especially in the beginning. Just thinking that their business return is separate from their personal return. If you are a sole proprietor or a single member LLC, you are filing them on the same return. So on the 1040 series, it'll be on a Schedule C. Then secondly, we have partnerships. So again, partnerships is going to be an actual entity created, but since there's going to be more than one individual, we have to figure out a way to distribute that net earning or net loss from the entity to its owners. And that's done by filing a Form 1065, which is the U.S. Partnership Tax Return Form. So that is you filing a return separately for the business. But partnerships are still passed through because upon filing your Form 1065, each partner will receive a Schedule K1, and that K1 will be passed down to their personal 1040 tax return. So essentially, it goes from informational return 1065, here's the K1s that get distributed, and that K1 now gets passed down to the owners of that partnership. A similar situation is created via an S corporation election. So as you can see from a previous slide, S corporations I did not include as being an actual entity because, contrary to popular belief, they are not. An S corp is not an actual entity. What an S corp is a tax election. You elect to be taxed as an S corporation. You are not an S corp. S corps by default will be either an LLC entity type or a corporation entity type. And then what changes that corporation or LLC to being an S corp is filing the Form 2553 and electing S corp taxation status. Similar to partnerships in corporation, which is a kind of a combined effect, S corporations are going to file an 1120S, which is the informational return for that S corporation. Upon filing that 1120S, similar to what happened in our partnership scenario, each shareholder of that corporation is going to receive a Schedule K1 that they are going to report on their personal 1040 tax return. Electing S corporation as a C corp or as an will allow the entrepreneur to avoid that whole idea of double taxation, since there is going to be no tax assessed at the corporate level. Taxes will only be assessed at the individual level, which is why S corporations create pass-through entities when you have an LLC or C corp entity structure in the background. Additionally, S corps allows us to avoid self-employment taxes, and we'll dive into this a little bit more later in our presentation as well when we talk about tax types. So just to recap, when you have a partnership or S corporation, know that you are going to file a separate tax return for your business entity, but at the end of that return, each partner or each shareholder of that corporation will receive a Schedule K1 that has to be filed on their personal 1040 tax return. If it's not filed and it's filed separately, you may trigger yourself for an audit. So again, just be in the know of how your entity is taxed and how to maneuver during this tax season. And then very briefly, we'll just talk about not-for-profits, right? So another myth is that not-for-profits don't have to file tax returns, right? And as we all know, the IRS is in everyone's business. So even if you do have a not-for-profit entity, you are still going to be required to file a tax return just like any other for-profit business. Let's talk about the Form 990. The Form 990 is the tax return that tax-exempt organizations, 501(c), are going to file with the IRS every single year. Not only is it providing tax information to the IRS, it also alerts the general public and allow them to evaluate the not-for-profit organization's information, which includes their mission, their programs, and also their finances, right? You want to make sure that if I'm donating to a not-for-profit, their finances are being spent where we believe that they were supposed to be being sent to based upon that organization's mission and vision statement. If you have a not-for-profit and you have gross receipts of less than $200,000, so that's donations for the full year, and you have total assets of less than $500,000, you can actually file a Form 990 Easy, which is a shorter version of the whole 990. So it's a quicker form to file, but it still provides the IRS with adequate information to know that you are operating your not-for-profit entity. Lesson 2. So now we're going to dive into tax types. Again, taxes are everywhere. Every time we turn around, we're paying a different type of tax. So let's understand what type of tax types we should be considering as small business owners and entrepreneurs. Every business is unique and should be treated as such. This is very important to remember because your product or service that you offer, the state of which you operate in and out of, how you're paying yourself, in what industry that you are currently in, can all influence what type of taxes you will be subject to as a small business. So again, be aware of what you're selling. So whether it's a product or service, because that could trigger you having to pay sales tax, right? The states of which you're operating in or out of may require you to be in compliance with state tax laws for those states, or maybe even the new Nexus laws. And how you're paying yourself, whether through owner's draw or through payroll, will dictate whether or not you're paying self-employment tax or payroll tax, right? And then lastly, depending upon your industry, there may be some industry-specific taxes that you may have to pay. If you're in real estate, that may be real estate property taxes. If you are in trucking, that may be fuel and excise tax, right? So again, be aware of these 4 points. Let's talk into the types of taxes that many business owners currently face. The biggest is going to be self-employment tax, which I think most individuals may be unaware of. So let's talk about what self-employment tax actually is. Essentially, the self-employment tax rate is currently 15.3%. That encompasses 2.9% of Medicare and 12.4% of Social Security. If you have a W-2 job, many of us are used to getting a pay stub and seeing a certain amount of Medicare and Social Security taxes withheld from our paychecks. That same requirement is satisfied even when you are an entrepreneur. We're not exempt from paying in Medicare and Social Security. How we pay it is different. If you have a W-2, you're paying these taxes throughout the year via each of your individual paychecks. When you're in business, this tax is typically due upon you filing your tax return after year end is closed. For most businesses, you do want to get into the habit of paying your business taxes on a quarterly basis to avoid having a cash flow issue in tax season due to the fact that you're paying a lump sum at one time. So self-employment tax, again, that's Medicare and Social, and whether you are an entrepreneur or W-2 employee, you're still paying those two taxes. But for those of us who are businesses, we pay them ourselves, which is why it's called self-employment tax rather than it being payroll taxes. And then now we'll get into payroll taxes. So again, now, for example, payroll taxes are due once you set yourself up with payroll for your own company. Most entrepreneurs don't have actual payroll set forth, and instead they take owner's withdrawals from their business. Owner's withdrawals are going to be essentially subject to self-employment tax. You can avoid some of that tax by setting up payroll and actually paying yourself a salary, especially when you have an S corporation. Payroll taxes that are going to be due, again, we have our Social Security and our Medicare. However, because you are now an employee of your business, at the individual level, you are only responsible to pay half of those taxes, and that comes from your net pay. And you as the employer, so your company, is going to be responsible for paying the employer portion of these taxes, which allows this to become a business deduction for your business. And again, by having payroll, you can be eligible to elect S Corp tax status, which will allow you to save a lot more in regards to paying some type of payroll tax. And then we have some type of state taxes. We have sales tax, right? So if you're selling an item, you do want to check with your state government website and see whether or not the product or service that you are providing is subject to sales tax. And yes, some services also are subject to sales tax. And even some digital courses, for those of you who have online courses, check in with your state because those may be subject to sales tax. Then we have gross receipts tax, which is also state specific. So certain states like New York, California, enforce a tax on the amount of income the business generated at the gross level. And that tax is to be assessed and paid at year end also. And then we have franchise tax. Certain states like California, Delaware, it's a big state with franchise tax. You're paying this franchise tax every year. And in most cases with these states, if you fail to pay these taxes, you may be at risk of having your business entity dissolved involuntarily. So you want to make sure that because you are operating in a state, you are in the know of what type of taxes are specific to that state and to make sure that you are actually compliant. Lastly, we have Nexus, which was created just a few years ago. And Nexus essentially is a rule that states if you gross more than a certain amount of income in a state of which you are not headquartered in, you may still be liable to pay that state some sort of sales tax as well. So for most people who do e-commerce, maybe national service provider, you want to make sure that you are in compliance with the Nexus rule, and that if so, you are filing taxes in the state of which you live and the states of which you work to make sure that you are in compliance with the Nexus ruling also. Our last category is going to be industry-specific taxes. So again, I gave you guys the example of being a truck driver where you have to pay fuel and excise tax, or if I'm a real estate investor, I'm going to be subject to paying property taxes. So there are certain taxes that are specific to your industry, again, that you want to make sure you are aware of to ensure proper compliance, because compliance guarantees that you are securing the bag for your business and you're able to leverage what you are building to continue to build generational wealth. Taxes does matter a whole lot, especially when you are applying for funding, trying to seek some type of loan assistance or to grow your business via a grant. You want to have your taxes filed. So be in the know of which of these buckets you should be paying more attention to, in that you are in the know of what taxes are due for your specific business. So now let's hop into everyone's favorite, and this is just, me being, give my opinion on favorite. The next is going to be lesson 3, understanding tax incentives, right? How do we really secure the bag and protect the bag by not overpaying an amount that we don't have to the IRS and to state agencies as well for taxes? Just remember always, again, that the tax code was created in favor for those who own businesses, resources, and land or real estate. And if you think about it, here's why. Those who own businesses have the potential of creating jobs. Obviously, when we watch CNBC or, Pix 11, with most economists, the main concern is that unemployment rate, right? And they want to get it down, have most Americans be actually employed. If you have a business, you have the opportunity to go ahead and employ someone and feed a family and provide for a family through your business. So of course, since you're helping us as the government, we don't have to put that person on a social program. We're going to give you good tax incentives because you're doing us a favor. We're in business together. If you own resources, same thing. Agriculture, think about the fact that farmers are the reason why we eat vegetables and fruits today, right? So of course, because they are providing to the greater whole of the society, we're going to give them better tax breaks. And those who own real estate and land, well, guess what? They are providing shelter. They're providing protection for individuals, and they're taking homeless people hopefully off the street by having a property for them to live and reside in. And for that reason, we're going to go ahead and give you tax breaks, right? So look at the tax system as an incentive system. The more you grow in business, the better tax incentives you are allotted. So also know that there are two types of ways of looking at you avoiding to pay taxes or minimizing your tax liability. The first is going to be tax evasion. This is what we don't want to do, right? So tax evasion is the illegal non-payment of or underpayment of taxes. So that's me being negligent and not adding on forms to my tax return because it may cause me to owe. It's me not being honest about my business revenue because I don't want to owe. That is what we call tax evasion, and that's punishable for up to 5 years in prison. However, we have the ability to legally avoid taxes, which is tax avoidance. This is, again, the enforcement on legally using the tax code to your own advantage to reduce the amount of taxes that is payable by means that are written in the law. The tax code has its black and whites, but then it also has gray areas of which, as long as you can prove to the IRS that you have sufficient grounds to make that claim, you can go ahead and take that tax position. And that's what we call tax avoidance. That can be done through structuring your business. That can be done through paying yourself the right way. But there's ways for us to incentivize ourselves in business to perform better that is also going to allow us to grow and legally learn how to avoid taxes. And let's get into the ordinary and necessary rule, which is one of my favorite things to discuss because people always ask me, like, hey, SHENEYA, what can I deduct? Or, hey, how much is too much to deduct? And honestly, there's no cap. There's no threshold on what you can deduct in business, again, as long as you have sufficient grounds as to why you made that claim. To be deductible, the business expense has to meet the ordinary and necessary rule. So what does this mean, right? Everyone wants to know. Well, ordinary, meaning that expense is ordinary in your course of business. This is similar to me saying, hey, I'm an accountant. Let me go ahead and buy a laptop. Let me lease the office space. Let me buy a new mouse. That is an ordinary expense in my trade or business, right? I'm an accountant. It's looked upon for me to have a calculator at all times. That's ordinary. What's not common is if I was an accountant and I'm paying for a tractor trailer, right? I'm not in agriculture or manufacturing, so I should not have a tractor trailer. It's not ordinary in my course of business. But again, the IRS allows you to defend it. So if you believe it's ordinary, you can take the attempt and go ahead and defend your position. A necessary expense, on the other hand, is one that is helpful and appropriate for your trade or business, right? So again, accountant, calculator, necessary. Secondarily, accountant, music box, not necessarily necessary, right? If I was a music artist, I needed a production studio, that would make sense. But to be an accountant and expense a production studio, it wouldn't make sense unless that production studio was used to help produce accounting content, because now I made it necessary, right? I made it ordinary. So again, you want to make sure that you are fitting into these two rules. The expense has to be both ordinary and necessary for you to deduct it. So of course, I had to give you guys some good tips on what is actually deductible, right? These are some common ordinary and necessary expenses that are pretty much universal for small businesses. Say, for example, we have incorporation fees, right? The fee that you are paying to start your business is a tax deduction. It's ordinary because without it, you would never start your business. And it's necessary because most businesses in your industry will also have incorporation fees included in their finances. Then things like business consultation, paying for an attorney, paying for your patents, your copyrights, your trademarks, payroll taxes are deductible. If you are paying contractors to assist you in your business, that's deductible as well. Advertising and marketing, Facebook ads, Google ads, Instagram ads, tax deductions. Software and technology. So if you're paying for G Suite, if you're paying for things like Canva, these are tax deductions for your business. Continuing education, which is one that is mostly common overlooked. If you're paying for courses, if you're paying for one-on-one coaching to help you be better in business, that is also an expense, and that can be booked as continuing education. If you have cost of goods sold, so if you have a product that you're selling, that cost that went into making that product and shipping it out can also be deductible. So again, here is a list of deductions. You guys were also provided a list of tax deductions from our amazing Magenta Edge team. So feel free to look out for those resources as well. And then we have business use of home, which is one of the most common overlooked expenses as well. We are all currently working, from home for the most part, even if you are working in the office a couple of days. If you are doing work from home, and that can just be logging onto your computer and answering emails, or speaking to your clients on Zoom, or scheduling meetings on Zoom, or working on your content at home. You are working from home for your business. Thus, the IRS does allow you to deduct that portion of space that you use exclusively just for business as a business expense. And this is going to be inclusive of not just your rent, but your utilities, any repairs and maintenance, etc., that went into your overhead for you to have your home and provide a space for you and your business to work from. Always note that you cannot fully deduct the whole amount of your home, because obviously the IRS can argue back that without your business, you would have been paying those expenses anyway. And you have to know that personal expenses are typically not tax deductible. It has to be a business expense. So say, for example, I use a space in my home that's its own private room. That room is 500 square footage. The whole square footage of my house is 2,000 square footage. We create a 1/4 fraction. That 1/4 fraction now gets applied to my mortgage or my rent, my utilities, my repairs and maintenance, so we can attribute a portion of my home expenses to my business's home office. So really, really great tax incentive to make sure that you are securing for this tax season. And then lastly, I just want to talk about some tax relief for those who have been experiencing maybe some operating losses due to COVID and what happened last year with the economy in general. So note that we have the option to create a net operating loss, carry back, and carry forward. So this is going to be a deduction that you take in the income in the year that you may experience a net operating loss. So say, for example, I made $500,000, but my expenses were $600,000. I have a net operating loss of $100,000. So you can use the net operating loss from deducting it from your income in another year or years. So you have the option to carry that loss back or carry that loss forward. And the benefits of carrying this loss backward or forward is that it's going to reduce the amount of taxable income your business had assessed, meaning that you can effectively lower your tax rate, which is obviously all of our goals, right? Let's pay the least amount of taxes and retain as much income that we can. Another tax relief that is super common right now is the employee retention credit. So if you retain your employees on your payroll from 2020 into the end of 2020, which has to be equal to 50% of the qualified wages of the eligible employer pays to employees, you can qualify for the employee retention credit, which is, again, a new tax law that was created in the midst of the pandemic. So as I stated in our first slide, tax laws can change constantly. So as things change in your business or in your personal life, you always want to be consulting your tax advisor to make sure that you are in compliance with what's going on. So that pretty much wraps up our presentation today. Just to do a quick recap, we talked about entity tax filing, right? So understanding how your structure is going to influence how you are taxed. And then we secondly went into understanding what other types your business may be subject to, whether that's sales tax, payroll tax, fuel and excise tax, property taxes, your industry, and what state you operate of and how you operate, what you sell, all determine what type of taxes you may be subject to. And of course, everyone's favorite, well, AKA my favorite, tax breaks, right? We just talked about how to use the tax code in your advantage to allow you to legally reduce the amount of taxes that you're going to owe. And that pretty much wraps up our combo. So again, thank you all so much for your questions. Number one, you asked amazing questions. I hope you all had a great time participating in the polling and learning with me. Thank you for attending today's workshop. As a reminder, if you want to see the articles and stories on Magenta Edge and register for the upcoming workshops, go ahead and visit tmobile.com/Magenta Edge. Again, thank you all. And if you want to stay in contact, follow me on IG at The People's CPA with an S. Thank you all so much.